Welcome everybody. Today's webinar is going to be on Know Your Numbers and it's presented by me. So just a little bit about me. So today's panelist is me. This is my email address if you do need to contact me. I'm the founder of Seed Accounting Solutions, and I set it up 5.5 years ago with a view to sort of change the face of accounting, and the profession has massively changed in the last 5.5 years, and I've been really excited to see some of those changes, and I believe that it will really benefit small business owners hopefully in the future. So that's me. You can come and follow me on Instagram and Facebook, mostly Instagram nowadays. So that's me. Before we get going, here's a thought for the session. Firstly, thank you very much for taking the time to be here. But before I start, I wanted to share this. The budget is not just a collection of numbers, but an expression of our values and aspirations. Now, hopefully you've all updated your budgets and forecasts to reflect the challenges that have come as a result of the COVID-19 situation. And these numbers in your budgets and forecasts will express your aspirations for the business over the next 12 months. And it's really important to make sure that you can understand, monitor and measure what you've set in those budgets and forecasts. There's no point just having those things on paper and then not doing anything with them and shoving it to the bottom of a pile. This webinar is about demystifying the most common reports that you'll be seeing, you know, whether it's sent to you by your accountant on a monthly basis, on an annual basis, or management reports that are sent on a quarterly basis, or perhaps even monthly, or indeed if you just want to have a look and see how your business is doing at any given point. If you're using something like Xero or QuickBooks Online, then you can access these reports, and it's really important that you are able to understand what those reports are telling you. It helps you to stay in control of your business. And that's what today's session is all about. So another quick slide about our core values at Seed Accounting Solutions. Now, my team and I got together early last year actually, to really help understand what our goals were and our values. And basically every fundamental decision that we make and every action that we take in our business is based on these core values, which is to educate, support and empower our clients. Our webinar program is a combination of these values. Obviously the primary one being to educate you, but also by educating you, we are empowering you, we're helping you, take control and drive your business forward and achieve the things that you want to do. And by doing that, we're also supporting you. So our passion is to work with small businesses to help them achieve their goals through a strong working relationship. And these three core values can help us live into those goals. So here is what we're going to be going over in the next hour. So we'll cover the importance of knowing your numbers, an overview of the different reports you should be producing, the difference between profit and cash, very key difference there, the key drivers of business value, how to protect your assets and how to adopt best practice. We'll then be outlining some potential next steps for you to take to make sure you truly understand your numbers. And finally, please make lots of notes today. I'm going to go through an awful lot of information and it will be really helpful for you if you've got some notes to go back to. Obviously, you will have the recording of this webinar, so you will be able to access it and rewatch it. Some of what we talk about might sound like a bit of a foreign language to you. We like to call it accountanese. So please do send your questions through at any point throughout the session, and we will answer them at the end. So, firstly, why you need to know your numbers. So knowing your numbers is vital as it allows you to interpret your business reports and know if you're on track to achieve the goals set in your business plan or your business recovery plan. These are my top 6 reasons why you need to know your numbers. They tell the story of your business, allowing you to interpret the results of your business activity. This in turn helps you identify the symptoms versus the root causes. For example, a decline in gross profit is a symptom of many root causes such as ineffective pricing, rework, poor purchasing, wastage. It could be a whole host of reasons. Knowing your numbers also enables you to spot the early warning signs of a potential issue. Monitoring how long it takes customers to pay you allows you to quickly respond if that number starts to increase. Areas of strength and weakness are highlighted. For example, your balance sheet indicates whether your business value is going up or down. Understanding your numbers also means you have a reliable financial information to base your decisions on. And finally, knowledge is power. The more you know about your business, the better your business will be. So these are the key reports that we're going to be going through today. They are the main reports that are used in most businesses. And each of these reports we will go through how you can understand them and what you can learn from them. So we'll show key learnings and things to look out for as well. We'll be using the same fictitious company, Foods Co, for the examples. So your trading account tracks your sales, variable costs, and gross profit to calculate the return you're achieving before deducting your fixed overhead costs. Now, variable costs are ones that increase or decrease for whatever reason. They aren't your fixed costs. They're not going to be your salaries. They're not going to be, any fixed insurance costs or whatever. They're going to fluctuate. So, for example, in this food company, it could be the ingredients that they're buying for the food. Your gross profit percentage indicates whether your margins are improving or deteriorating. You can track your results across different divisions or product lines by using multiple trading accounts. For example, if you have regional locations, having a trading account for each location allows you to track how each is performing. Small adjustments to the items on your trading account can have a huge, huge impact on your results, and I will go through that now. Just so that you're aware, a trading account nowadays is generally just found in your profit and loss or your income statement, which we will go through later. But this is basically the top part. The trading account is a much more detailed report and looks into these figures in a lot more detail. So next slide. There you go. So this is an example of a food manufacturing company's trading account. As you can see, they had just over £1 million of sales, cost of sales of just over 318,000, giving them a gross surplus from trading of just under 700,000. Their direct costs were just over 450,000. So their gross surplus was just under 250,000, giving a gross profit percentage of 24%. Let's say this company undertakes coaching with their accountant, for example, and implements strategies to increase their customer retention rate, resulting in a 10% increase in sales. That's that. They also work with their accountant to review their inventory processes and reduce their cost of sales by 5%. They renegotiate their contract with the delivery providers, resulting in a 5% saving in their direct costs, as you can see there. And as a result of all these changes, their gross surplus has increased by 140,000. And their gross profit, as you can see down there at the bottom, has increased from 24% to 35%, which is a huge jump. Understanding your trading account allows you to identify areas where small improvements can have a huge impact on the profitability of your business. If you can imagine how you can increase, even just 5% of your sales and the difference that will have, and it will trickle down, it's really important to understand how those tiny little changes will have a positive impact on your business. So your profit and loss statement, also known as an income statement, depends on what software you're using and who you're talking to, shows all of your earnings and costs over the year and tracks the overall performance of your business. It matches your income and expenses for the period with adjustments made for timing differences, for example, sales that have been made but money hasn't been received yet, and those kinds of things. It's important to remember that profit is not the same as cash. Your profit and loss statement is not going to show you how much money you have in your bank account, but it does give you a good overview of how the business is performing. The profit shown in your profit and loss statement includes non-cash expenses such as depreciation, which we'll go through into a little bit more detail in the future. So you need to make sure that the profit that you have that is showing in your profit and loss statement is enough to cover cash costs such as loan repayments, asset purchases, any drawings that you make as a business owner. Those kinds of things aren't going to show on a profit and loss statement. So it's important that your profit that you have on your profit and loss statement is enough to cover those additional expenses. Your profit and loss statement provides a framework to benchmark your results by using percentages or comparisons between years to compare your business performance to similar businesses, or indeed just against itself and its performance, one period to the next. In my business, I regularly check my profit and loss statement. I check month by month to see how we're doing on a month performance basis. And I also compare where we are, for example, in this current day in our financial year compared to the same time last year. Those kinds of things are really helpful at identifying how the business is performing. So businesses are generally valued using a multiplier of earnings. So your profit and loss statement is a fundamental driver of the value of your business. So the higher your earnings, the higher your value. Different businesses and different industries value businesses slightly differently. So they're not always just on turnover. It might be to do, they will take into account things like profit and assets and things like that. But it is usually based on the sales, because the earnings are what can be transferred over. Say, for example, if you were to be acquired, the sales will continue, but the costs might be very different. So that's the profit and loss statement. We're going to go into that in a little bit more detail now. So this is an example of a profit and loss statement using the same fictitious food manufacturing company. So we've taken a gross surplus of just under 250,000 that we looked at in the trading account. And we've listed all of the expenses followed by the owner's remuneration, very important one, to calculate the net surplus or loss in the business. So as you can see, the company is currently trading at a loss of over 113,000. So let's say this company undertakes a review of all of their expenses with their accountant and identifies potential savings to be made to their insurances and to their rent. So they've got 5% decreases in both of those, which helps them save £597 in insurance and £2,868 in their rent. However, you'll notice that accountancy fees have gone up. Remember, in a previous example, the company had engaged their accountant for coaching and other services. Despite the increase in their accountancy fees, the overall net surplus has increased by 138,000 to 24,000 due to the savings that have been made, which for an extra little bit of money to the accountant is a huge bottom line increase. So they are now making a profit of 24,000, which, if you're making a profit and you have the available retained earnings in your business, that can then help you to pay yourself a dividend and pay yourself more as a director or shareholder. So that was the profit and loss statement. Swiftly moving on to the balance sheet, which isn't often overseen. I think it's overseen a little bit. It's not overseen. It's not really the right word, but it's ignored. It isn't looked at as much as it should be. But your balance sheet, which is also known as a statement of financial position, it provides a snapshot of your business's financial position at a specific point in time. It measures the net worth of your business, which is your assets less your liabilities. So it also shows if your business is solvent. If your liabilities are greater than your assets, then the business theoretically is insolvent and urgent action is needed to fix this. Very important to have a look at this balance sheet, which is, as I said, often ignored, but is actually one of the fundamental reports that you need to look at to ensure that your business is going to survive. You can compare different periods to determine whether the business's net worth is increasing or decreasing between years, and you can track the strength of the business as well. The stronger your balance sheet, the easier it will be for your business to survive a downturn. And that's really why it's so important now more than ever to make sure that your balance sheet is looking healthy. The balance sheet is also the report that is the basis in which to calculate key ratios such as debtor days, inventory days, your liquidity ratio, and those kinds of things. And those are the figures that, for example, lenders will look at to see whether they're happy to lend you money, and investors might want to look at it to see how they're going to get a return on their investment. So the balance sheet is a really important report to look at. So here we go. We've got Foods Co again. So as you can see, the company is currently insolvent. It's got more liabilities than assets. Now, this balance sheet, just so you're aware, is set out slightly differently to, for example, the one in Xero that we use. Normally, the equity account, which is up at the top in this report, is down at the bottom. But it's important to understand that they will be shown, some reports just show them slightly differently. Ultimately, they're showing you the same thing. It's all the same information. So as you can see, right down at the bottom, sorry, the net assets are a minus figure. So its working capital is also negative. So current assets of 138,475 are less than the current liabilities of 162,000. This means that the company cannot pay its short-term debts from the limited cash, debtors and stock it has on hand. So current assets are ones that are used up on a regular basis. Non-current assets are sort of longer-term investments. As you can see in this report, it's property, plant, equipment, goodwill, branding, and so on. So urgent action is needed to remedy this. You know, the cash that you've got available in whatever unpaid bill, unpaid sales, in your cash account, on your credit card, and so on, isn't enough to cover your taxes, any other sort of liabilities, current liabilities that you have. The business needs an injection of funds of at least 305,000, which may be in the form of share capital or a shareholder loan. You may also be able to apply for a bank loan, but in this current financial situation in this report, it's unlikely that they would get one for a decent amount of money. It's probably going to be quite risky. So assuming the company can resolve these urgent insolvency issues, there are other areas for improvement too. So over the long term, the company could implement strategies to reduce their debtor days and inventory days to increase their cash flow. So to calculate your debtor days, you have to divide your debtors. So that's your trade and other receivables. It might also be called accounts receivable. It could be trade receivables, all different types of names. But effectively, you've got your debtors and you divide it by sales and then you multiply it by 365. This tells you how long it's taking your customers to pay. So this figure here of 72,000 is obviously taken from your balance sheet. The sales figure is taken from your profit and loss, and then you times it by 365, which is obviously the days of the year, and you get to the answer 26. So this tells you that it's taking their customers 26 days on average for the customers to pay their bills. If they updated their terms of trade and requested payment within 7 days and managed to reduce this by 5 days to 21 days, because just because you've got terms of trade of 7 days doesn't mean that your customers are actually going to pay you within 7 days. But say theoretically, you put in your terms of trade, payments requested within 7 days, and therefore people start paying a little bit sooner, and some may well indeed pay you within those 7 days, you're likely to reduce the overall debtor days by 5. As you can see here, that would bring in an extra £13,944 in cash. So to calculate inventory days, similarly, you divide your inventories over here on the balance sheet of 64,000, highlighted in yellow there. Inventory might also be called stock, but in here it's called inventories. You divide it by your cost of sales, which again is on your balance sheet, on your profit and loss. And then you multiply it by 365. This is telling you how long your business holds its inventory for before it is sold. In other words, it shows how long your cash is tied up in inventory. If you've just got stock sitting there, it's not making you money. So this company currently holds inventory for 74 days. Depending on your business, that might be average, it might be very high, it might be very low. For example, in a supermarket, they're going to want their inventory days to be much lower because you've got lots of fresh food with sell-by dates and so on. You can't have an inventory day of 74. And so theirs are going to be a lot shorter. Very much depends on the type of business you have. So if they reviewed and updated their inventory process and reduced the amount of inventory they have on hand, they might be able to improve their inventory days by 9 days. So if you can reduce it by 9 days, this would result in a cash flow boost of £7,860. And obviously, again, that's quite a big boost to the cash flow. Whilst this cash flow gain of debtor day improvement and inventory day improvement brings in nearly 22,000, it doesn't actually solve the solvency issue. It just demonstrates how much cash could be saved with some help from their accountant or whoever's helping them do this and identify these figures. So bear that in mind, the things that you can do, the little things that you can do to improve, but you can only do this with this helpful information. So it's really important that you have a firm grip on how to interpret this information in your reports. Statement of changes in equity. So this is the report that shows what happens to the profits. They could be paid out as dividends, or they can be kept in the business as retained earnings. They might want to reinvest them to grow the business forward or whatever. It represents the net worth or the value of the company and is a key indicator of the company's financial health. It shows whether a company is solvent. And remember, if the company has more liabilities than assets, it's insolvent and funds will need to be paid into the company. There are also rules around insolvency, and it is worth making sure that you know we aren't insolvency practitioners. There are specialist insolvency practitioners that can help businesses get out of insolvency, but that's sort of long-term insolvency. Hopefully by making some of these changes, you can bring yourself out and into a solvent position. So this is what a statement of changes in equity report looks like. The company has accumulated losses for at least the last 3 years, and this means the company has absolutely no retained earnings and is currently insolvent. There's no money to pay out as dividends to the shareholders, and there's no money to reinvest into the company to purchase new assets. So the directors must now take action to increase profitability of the company. It's no good just throwing money at it unless you're going to solve the problems. Now, the shareholder current account, this is generally known as a director's loan account. Shareholders and directors are very different people. There are differences in their terms, but for the majority of the businesses that we work with, the directors are also the main shareholders in the business. So assume it's a similar thing. So the shareholder current account records all of the funds introduced to the business by shareholders or directors or taken out of the business as drawings. It can help you monitor your personal expenditure from the business, and for businesses with more than one shareholder, it maintains the balance of the amount each shareholder has introduced or withdrawn from the business. So it shows how much the business owes to each shareholder. If the account is overdrawn, it means the shareholder has taken out more than they've put in and now owes the company money. And this is something that we are seeing happening again and again in our small businesses. People are taking out more money than they're entitled to, and this has severe tax implications, which need to be sort of looked into and worked out. But it's really important to make sure that you keep on top of this account. To put the account back into a positive balance, the shareholder can either repay the loan, or the company can increase its profit to pay a shareholder's salary, or a dividend can be declared. Those are the various different ways that can be processed. It can't just be written off. Well, it can be, but there are tax implications. So if your shareholder or director's current account is overdrawn, it's important to get advice from your accountant as soon as possible to discuss the best options for you and your business. So please make sure you keep on top of that nicely. I'm going to go into the actual report now. So in this shareholder current account, it shows that at the start of the period, the company owes its sole shareholder, Mr. Doe, just over 29,000. So he's owed 29,000. He has introduced a further £2,000 into the company during the year, but he's taken out just over 9,000 in drawings and life insurance payments. This means at the end of the period, the company now owes Mr. Doe just under 22,000. The amount owed by the company to Mr. Doe can only be repaid if the company is solvent and has the cash available to make the repayment. Because our company is insolvent, Mr. Doe will need to introduce more funds into the company so that it's not trading while insolvent. That's one of the rules around the business, is that you're not allowed to run a company and trade through a company if it's insolvent. Now, for the majority of owner-managed businesses, they will just be funded by the director one way or another. So to ensure the company will be able to repay the funds introduced, a profit improvement strategy should be implemented so the company becomes profitable. For example, we demonstrated in the trading account how small changes can result in an improvement of 138,000. It's not sustainable for the shareholders to keep introducing money into the business if it's not profitable. That's just sticking a plaster on something and hoping it's going to fix it without actually fixing the problem itself. So don't just keep throwing money into the business. You must look at the reports and see what they're saying to you and see how you can make those little changes in your business to actually make it profitable. Next one, fixed asset register, of course, storming through. So the fixed asset register, also known as the depreciation schedule, records a business's fixed assets such as vehicles, plant and equipment. So it might be computers, furniture, it might be printing presses and things like that. And it facilitates the spread of the cost of the assets over their useful life. It provides a basis for keeping track of a business's assets and can be a useful guide to determine when assets need to be replaced so they can be budgeted for accordingly. So for example, a laptop. You buy a laptop, nowadays they last, 3-4 years if you're lucky. So most laptops, for example, would be written off over a period of 4 years. It's also useful when selling a business as it records the current value of all of the fixed assets. So obviously if you had a laptop and the company was purchased 2 years into the laptop's life, you would know the given value of that laptop after 2 years. So in Xero, they have a brilliant fixed asset register tool. A lot of people don't know about it. We use it for all of our clients and post all of the adjustments on a quarterly basis or an annual basis, depending on the business. So this is the fixed asset register for my fictitious company. So the first column of the fixed asset register lists the names of all of the fixed assets, with the second column listing the cost of the asset on the purchase date. So here you can see we've got motor vehicles, office equipment, and plant equipment. The next column shows the opening value of the asset at the start of the financial year. This is the cost less the accumulated depreciation from the previous period and previous periods prior to that. The next two columns show any purchases or disposals of the assets. A disposal could simply mean that the asset has reached the end of its useful life for depreciation purposes and no longer holds any accounting value. It might not necessarily mean that you've actually disposed of it. You might still have it in a business, it's just not worth anything anymore. We then have the depreciation rate and the method of depreciation used. This company uses the diminishing value method, which depreciates each asset by a constant percentage each year. So what that means is, so for example, this van, it's written off, 30% is written off 22,000 every single year. There's other methods, and it depends really on the accountant and the asset value as well. And it would normally be determined when the accounts are prepared. We then have the depreciation for the period, followed by the closing accumulated depreciation. This is the amount the asset has been depreciated by since it was purchased. So we've got purchases and disposals, the rate at which it's used in the method, depreciation, and then the closing accumulated depreciation. Finally, we have the closing value column showing the current value of the asset. This is the value that will be recorded in the balance sheet. So this is obviously the cost minus the opening accumulated depreciation, plus or minus the purchases and disposals, minus the depreciation for the year, and then you get your closing value. So that sums up the 6 reports. That's it. We've gone through the main reports that you should be producing and reviewing regularly. Hopefully you have found some nuggets of information in there and you'll have a clearer idea of what those reports are telling you and how you can access them. These reports that I've gone through are actually a lot more complex than the majority of reports that you'll be looking at. So if you do have access to Xero or another accounts program, just have a little look, see what those reports are showing you and see if you can see what information you can get from them. Each report tells a different story about your business and aids your decision making in a different way. If you have any questions about the reports, please do let me know. If you've got any questions, obviously you can send them through the Q&A box, or you can send a question to me afterwards. That's absolutely fine. In the meantime, we're going to go on to the difference between profit and cash. So it's really common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. I've had so many conversations with people who say, but I've got money in the bank account. And that doesn't make any difference. Or they might even say, but I'm making a profit. Why haven't I got any money in my bank account? And that's because profit doesn't equal cash. It's essential that you understand the difference between a profit and cash, and why a high profit doesn't necessarily result in more cash in your bank account. And a profitable business can also go out of business because it's starved of cash. A business running at a loss can survive because it has access to funds from investors or financiers, but it doesn't actually solve any problems. If you just keep throwing money at a problem, it doesn't actually solve it. In other words, cash flow is every business's reality. So to demonstrate the difference between profit and cash, consider these items. First of all, we got VAT. This affects your cash balance, but it doesn't affect your profit. It's not going to increase or decrease your profit, but it will reduce your bank balance. So it goes over there on cash side. Then we got loan repayments. They affect your cash balance, but not your profit. They're not a trading expense. They're not creating better profitability in your business. Interest on loans. Now that affects both your profit and your cash balance because the interest is being paid out to the bank. So that's reducing your bank balance, but it's also an expense in your business. So it's reducing the profitability of your business. So that goes into both of them. Asset purchases, they only affect your cash balance. If you buy a car, it's not an expense to your business, a trading expense, and it doesn't improve the profitability of your business. It will sit on your balance sheet. In the same way, asset sales will only affect your cash balance, hopefully positively. And depreciation, this only affects your profits. This is not a cash figure. You don't get any extra money, you don't lose money by depreciating an asset. It just reduces the profitability of your business. So as you can see, even if your business achieved a healthy profit, there may not be enough cash in the bank after paying tax, making loan repayments and buying new assets. So that's a really important thing to look at. And this brings me on to the Business 101 cycle. It's another useful way to demonstrate the difference between profit and cash. So first of all, the owners need to invest money in the business. That's what you've got to do to start the business going. This money can then be used to purchase the assets needed to run the business. You might need to buy machinery, for example, in order to make your books or make your food or buy a laptop to actually get going in the business. The business may need additional funding to buy all the assets it needs, so they may take a loan to finance these purchases. If the money that's been invested by the business isn't enough, then a loan will help. These assets are then used to generate a profit. So you can increase your profit by growing your sales or your margins, but overhead expenses can drain your profit and result in a loss if they're not managed. So you've got your drains, you've got your gains. The profit then gets turned into cash. Drains on your cash can include slow collection of debtors, high inventory days, loan repayments, tax repayments, and payments to suppliers. Those are all the things that are going to reduce your cash balance. A business can achieve cash gains by collecting their debtors faster, decreasing their inventory days, negotiating longer payment terms with suppliers, and reducing their tax. And then finally, the owners can take the cash out of the business's drawings or personal loan repayments. So the remaining cash can then be reinvested into the business to purchase more assets to generate more income. The aim is to go through the cycle as quickly as possible to increase your return on investment. Now, that return on investment is used quite heavily nowadays. If you think about when you invest money in a service or a product or an asset, you want that money, you want the money that you have spent on that to come back to you as quickly as possible and back into the business. You don't want it to have just ended up becoming yet another expense in your business that hasn't benefited the business in any way. So after cash flow, business value is the next most important measure of business success. Part of knowing your numbers is understanding and measuring the drivers of your business value. These drivers might be your monthly recurring revenue, revenue growth, revenue per client, sales or profit. These are going to be different for every business, but we can work with you to identify the drivers of your business value. The drivers, we often call them KPIs or key performance indicators. There's going to be various different ones depending on your business. In my business, my KPIs are turnover, gross profit, and then net profit on net sales, which is basically the profit we make based on the sales that we're making. I also then have various other non-financial KPIs which don't involve numbers and might, well, instead involve things like how many proposals we raise each month, because that's measuring how many people we're getting in front of and how many inquiries are getting through that stage. There's going to be various different KPIs for every different business, and also they're going to change as your business changes. So for example, my KPIs are what they are for now, but next year they might be something totally different. To enhance the value of your business, you must first develop and implement a clear plan and document your organisation structure and roles within your business. And do this however big or small your business is. Having an organisation structure sounds totally bonkers when there's just one of you or even two of you. But if you can identify all of the different roles in your business, then it's easier for you to then go on to delegate or potentially fill those roles by other people. It also helps, if it is just you, for you to document your time and organise your time better throughout the week to ensure that all of those roles are being covered. Establishing cloud-based real-time reporting allows you to make better decisions, and reviewing and documenting your systems and processes ensures your business is running as efficiently as possible. And that's the reason that we get all of our clients who run limited companies onto Xero. We don't allow any other software just because we prefer to specialise in one. But Xero is there, and it has all of the information that a business owner could possibly need to drive their business forward. Reducing the reliance on the owners of the business also helps enhance the value, as it will be easier for new owners to take over when the business is sold. So if one of your plans for your long-term plans for your business is to sell it, you need to make sure that it isn't reliant on you running it. Because if you take yourself out of the business, will it collapse? If it's going to collapse, you need to make sure that you have better systems and processes in place so that basically when the business takes you out of it, it can continue to run. The E-Myth is a really good book for that. And finally, identifying and managing risks means these can be mitigated before they become an issue. And if anyone has watched the business recovery webinar that we did a couple of weeks ago, the risk register was a huge element of that. Finally, protecting your assets. As we've seen throughout the webinar, the profitability, cash flow, and value of your business all affect you personally. If your business isn't profitable and doesn't have much cash available, you won't be able to pay yourself to fund your desired lifestyle. And when I say your desired lifestyle, it might not be that you're, sailing around on your sort of 30th yacht or whatever. It might just be that you want to go on holiday, or you want to do certain things with your family. So there are a few things that you can do to help protect your assets. Set up your business as a company to limit your personal liability. Basically, it means that the company is the legal entity which will be held responsible for everything. Consider who should be a director of your company and which assets are held personally by directors. Ensure that you have security over any money you lend to others. In the same way, nowadays, when small business owners are applying for a loan, you're often asked for a personal guarantee. If you're providing a loan to a staff member or an employee or a director or a shareholder, make sure there's security involved in that. Consider alternative ownership structures for high value assets. For example, if your business owns the commercial premises you use, consider moving the ownership of the premises to a separate limited liability company. We also run a tax planning service, and we can go through all of the options for this to help you choose the best move forward to protect you. So we can do this with you. Review your terms of trade and credit policies to ensure you only provide credit to customers who are likely to pay you. Credit checking clients is really important. You don't want to end up finding that you're dealing with somebody who's got no credit facility at all, or they've got a very poor credit rating. And it might not mean that you don't work with them at all. It might just mean that you ask for the money up front and you don't give them payment terms. It might be, that you have to pay for everything in advance of doing a session. Not even that you just don't have any payment terms, it's just that it's paid for in advance, and that protects you. Review your insurances and make sure that you have sufficient protection. For example, do you have business interruption insurance? I'm sure if anybody who did have a business interruption insurance schedule before COVID, they're very happy that they had one in place. But it's really important. We just don't know what's going to come up in the future. So business interruption insurance is really helpful nowadays. Indemnity insurance and enough cover to ensure the impact on your business of any adverse effects is as minimal as possible. So make sure you have those insurance policies in place. Ensure you undertake financial planning to manage your personal wealth outside of the business. We work with a number of financial planners who will look at the bigger picture and the very long-term picture. And it's not nowadays just about having a pension for when you retire. It's so much more complex and there's so much more involved, and we're living so much longer. It's really important to make sure that you have those plans in place. And finally, plan for the future. Do you have an up-to-date will? Do you have powers of attorney and a clear plan for transferring your assets to the next generation? All those kinds of things are really important to make sure that you have in place to protect yourself, protect your business, and ensure sustainability in the long run. This isn't an exhaustive list, by the way. They're just some of the ways that you can protect both your business assets and your personal assets. As I mentioned, we do have a diagnostic service that we can go through and identify all the different areas that you can help your business and protect it and make the most of certain reliefs. So how does everything I've talked about today come together as best practice? We believe that every business should have 3 essential tools: an annual business plan, or in these times, it might be a business recovery plan. You might not have a business plan. I did a business recovery plan back in May, and I'm still using that now to keep going for the next 6 months at least. But an annual business plan, and I'm not talking about a 20-page detailed annual business plan. This is a 1-page business plan where you have all of the key information on it. An annual forecast, so that you know what you're working towards and to see if you're meeting those targets. Ongoing reporting and accountability. The reporting ensures the numbers you want to achieve in your plan and forecast are being measured. The accountability process is some form of coaching. Using an independent coach to hold you accountable really does work. I have two different people holding me accountable externally, and then I also have members of my team checking in on me, because as a business owner myself, I know how difficult it is trying to make sure that I'm doing what I'm supposed to be doing to drive the business forward. Knowing your numbers is just the beginning, as it allows you to improve them, and ultimately they then help you achieve the goals for your business. So your next steps. So where to from here in these challenging times? My aim is to help you take what you've learned today and implement some positive change in your business. So now it's time for you to decide what you're going to do. Take a few minutes after this webinar to write down 3 actions or projects that will add value to your business. They can be big, they can be small, but have a think. Just 3 things. It's not a long list. 3 things that you can do that will take your business that next step further forward. What problems are you experiencing in your business? Identify these problems and use them as an opportunity to create a project to fix them. So have a look at your reports, see what's missing, see what's going wrong, and take action. Doing nothing now should not be an option. And actually, somebody said to me a while back that the main reason for businesses failing is nothing to do with cash. It's nothing to do with sales or the economic climate. It is a failure to implement, or FTI, which I really like. I think it's really important. Don't bury your head in the sand. Don't ignore a problem. If you can identify a problem, you can fix it. Might not be an easy way, but you can fix it. So now you know what you should be doing as best practice in your business. I'm just going to go through a couple of the ways that we can help you. If you don't already have a business plan or a business recovery plan, we can help you develop one. So we are charging £1,250 plus VAT. There are payment plans available for all of these services, for the one-off services. So we can, charge installments. We can charge it over a period of time. Very happy to discuss that. So please don't let price be a barrier in any of these services. We can also create an updated cash flow forecast, which reflects the ongoing impact of COVID-19. For some of you, it might be that your business has bounced back and you're doing really well, but have you considered the longer term situation? There is evidence that we're starting into a recession. How's that going to look for our business in 6 months, in a year's time? If we're going to lose lots of jobs when the furlough scheme ends in October, how's that going to impact your business? Have a think about all of those things. For those that need to be held accountable to complete your actions, we have a range of coaching options depending on the frequency which suits you. We've got monthly, quarterly. The most popular coaching service that we have is the quarterly review session. And what we would do in that is we prepare a report which we send to you in advance of the meeting, and then we have a 1 hour meeting which goes through the report is kind of the pre-work. We have a look at that. That's the an analysis of the business performance and how it's doing. What we then do is identify the issues that have been raised in that, or the opportunities, and we go through that. And it's really important to have that fresh pair of eyes looking at your business. We don't currently offer virtual FD services, so this is like an interim service that is a small service, but a really important one. And that is, so it's every quarter, and we can build in other things. We can build in business plans that you can then, we can review on a quarterly basis and identify actions and set targets and things like that. Management reporting starts at £45 plus VAT per month. Now, what that is that's a roundup of the majority of those reports that I've gone through today, and we provide our analysis on the business performance. So we prepare them and then send them over to you. We normally find for the majority of our businesses that a quarterly management report is sufficient, because a lot of small businesses, not enough really happens in a month, each month, for the report to be meaningful. So a quarterly report is much better. So it would be £45 plus VAT per month is based on a quarterly management reporting service. And finally, I appreciate it might be difficult to commit to spending money right now, but if you aren't an existing client, we do offer a complimentary meeting where we can sort of assess some of the parts of your business. That's not an introduction to our services. It is very much just a review of your business and to see what steps you might want to take with your business. That's not a discovery call. It's nothing like that. It's just a review on your business. So we know that the benefits that you'll get from these services will be far greater than our fee. And most importantly, it's helping you out as quickly as possible. As I said before, I don't want cash flow to be a barrier to these services. It's so important to help you work towards a stronger, more resilient business. So I am very happy to discuss payment options with those. And finally, my little disclaimer, the information in this educational webinar is general in nature and is absolutely no substitute for specific tailored advice and support. Obviously, if you do choose to work with us, or indeed if you're already a client of ours, we can help identify the most important actions to take and that will make the biggest impact on your results. So, make a start. If you don't already have any of these services, make a start by looking at your reports yourself. And if you think you need some help, please do get in touch. So finally, thank you so much for making the time to attend this webinar. I think it's the first time I've ever not overrun, but I appreciate that time is very valuable, especially right now. I think a lot of you will have had children who have gone back to school either today or early last week, and you're probably head down, scurrying around in your work. But please do complete the brief exit survey that we've got following this session. It just helps us to continually improve our webinar program and also get feedback on what other topics you'd like to see from us. I hope I've given you plenty of ideas to ponder and some clear next steps for you and your business. I hope you have a lovely day, and I will see you again soon.